The S&P 500 just hit the 99th percentile. And the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface and the data confirms it. Right now, 10-year yield is at 4.57%, the 97th percentile for the past year. Historically, the 10-year at this level reprices every leveraged asset in the economy. Gammon says the Fed is breaking things and credit spreads will blow out. Snider says the euro-dollar system is tightening and nobody sees it. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The commodity analyst has been right for 157 straight days. Here is the full scoreboard. The commodity analyst's commodity supercycle call is paying off. Oil at $91.9 and trending no direction. 157-day streak, Snider's dollar liquidity crisis call is paying off. Yield curve at 0.43% and trending no direction. 7 days running, Gammon's credit will blow out call is paying off. Yield curve at 0.43% and trending their direction. 5 days running, the volatility expert is right and the data keeps proving it. VIX at 16.8, 5 days running. McElroy might be right, but the data has not confirmed the thesis yet. 156-day streak, Hartman is waiting on confirmation. The narrative holds, but the data has not validated it yet. 150-day streak, the dollar analyst might be right, but the data has not confirmed the thesis yet. 4 days running, score today, 4 right, 3 early, 0 wrong. Long streaks are powerful until they break. Track the signal, not the conviction. Today's big question. Everyone agrees on credit, so who's wrong? Gammon says the Fed is breaking things and credit spreads will blow out. Snider says the euro-dollar system is tightening and nobody sees it. Everyone agrees. In markets, that is usually the setup for a reversal. The crowd is most confident right before the data breaks against them. Here is what the data says. Investment grade spread at 75 basis points. High yield spread at 278 basis points, down 0.7% today. Yield curve at 0.43%, down 12.2% today. Bottom line, everyone agrees. The data hasn't broken yet. History says watch for the reversal. If investment grade spreads crack above 100 basis points, the bearish thesis gets a lot harder to ignore. Right now, they are at 75 basis points. If both investment grade and high yield drop below the 75th percentile, the credit stress call is dead. Investment grade spread at 75 basis points. We'll track it daily on the scoreboard. High yield spread at 278 basis points. We'll track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 75 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points. Currently at 75 basis points. Pace is flat or improving, no urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, copper-gold ratio flashing red. Snider says the euro-dollar system is tightening and nobody sees it. The data agrees with that assessment. Phase 1 holds with 75 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Orange, CA, payment burden is past the breaking point. Newport Beach, CA, median home about $2,704,000 on about $138,000 household income. Price to income ratio, 19.6. When the math stops working, sellers find out before buyers do. Marin, CA, payment burden is past the breaking point. Point Reyes Station, CA, median home about $1,549,000 on about $79,000 household income. Price to income ratio, 19.6. When the math stops working, sellers find out before buyers do. MI, days on market, is spiking in Morin. Days on market in Morin moved plus 100% in 30 days, now 147 days. Buyer leverage score, 50-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, everyone agrees on credit, so who's wrong? Let me show you what happened the last time we were here. The S&P 500 at 7,473.5 is in the 99th percentile. That means it is higher than 99 out of 100 days in the past year. In 2022, the S&P dropped 25% as the Fed raised rates at the fastest pace in 40 years. In 2020, markets fell 34% in 23 days, then recovered to new highs within 5 months. In 2018, a 20% correction in Q4 forced the Fed to reverse course on rate hikes. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, copper at $6.38 is in the 98th percentile. The last time both the S&P 500 and copper were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Gammon should be paying close attention because the clock is ticking on this pattern. Here's what the data says to do right now. Stay alert on VIX. It is dropping 3.9% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretched territory. Phase 1 holds. No alarms, but the runway at 75 basis points is shorter than last month. 4 out of 7 speakers are right: the commodity analyst, Snider, Gammon, and the volatility expert. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. The talking heads give you opinions, we give you the numbers. Subscribe and I will see you tomorrow morning with a fresh scoreboard.